want it out there, being butchered. It'll make you mad, even though you think it won't, but it will. All right, so risk management. This class is the only class you will ever see taught like this. Nobody else teaches it like this but me and Sean. Only two people teach it like this. This class will show you exactly what the risk to reward tool is. So everything you learn today, you will learn how to calculate the risk to reward. So that little risk to reward you use in TradingView, this is exactly what you're doing, but you're doing it manually. All right, you're just doing this manually. It is very important that you know how to calculate pips. It's very important that you understand your stop loss. It's very important that you know your risk to reward, because if you don't, you need to stop trading right now, and you need to stop trading. You need to learn this risk management, because if you don't, you will blow your account. I can guarantee it. 99% of traders fail because they don't know risk management. All right. I got veterans that trade. They still don't know how to count a pip. I hear people all the time says, I dropped a penny on it. You're not dropping a penny on any pair except Shiba. All right. So I don't want to hear you guys talking about I dropped a penny. All right. There's no such thing as dropping a penny unless you're trading Shiba or on one of those cryptos. That's it. Other than that, you guys are trading micros, minis, and standards. All right. That's what you guys are trading, not pennies. Not pennies. All right. 0.01 is not a penny. Remember that. So risk management formula, I want you guys to write this down. If you haven't already, all right, if you haven't already, write this down. I will unfocus this. There we go. There we go. All right. So write this down right here. This is going to be your stop loss. So risk management formula. This is calculating. This is letting you know your stop loss and take profit. If you were taking GBP, JPY sell, this is what it looks like when you're risk to reward tool. So your stop loss, how do they calculate your pips? They take the stop loss and they take the stop loss and it's minus the entry. So stop loss minus entry. This is how you get your stop loss, the number of pips. For your take profit, it's your entry minus the take profit. That's how you get your take profit. Entry minus TP. That'll give you the amount of pips from your entry to your TP in pips. Stop loss gives you the amount of your entry to your stop loss in pips. All right. For buys, vice versa. To find your TP in pips, you take the take profit and you subtract it from the entry. To find your stop loss on pips, you take the entry and you subtract it by the stop loss. Basic math right here. This is the big number minus the little number. Where it gets tricky is up here. All right, it takes practice to memorize this, but this is easy. This is the big number minus the little number. Give you guys a second to write that down. How'd you guys do today? You guys trade? What's your percentage? Anybody trade? I think I had like probably like 3% today. Nothing crazy. It was trap day. What y'all get? Nope. I got stopped out, but got back in. I was sick. I hear that. It happens. It happens. All right, so make sure you guys write this down. I sent this out, so you guys should all have a copy as well. I won't take too much time on it, but definitely write it down if you're taking notes, take screenshots, take whatever you need for it. But write it down because we are going to do some problems. All right, we got to do problems. I need your participation for people in the back that might not know this, and that's okay if you don't know this. We want you to know this so that you can make more money and not have so much drawdown. All right, let's talk about pips. The fifth number from the decimal is the pipette. All right, that is the pipette. So we have 1, 2, 3, 4, 5. The fifth number from the decimal is the pip. This one. This is your pipette. We don't care about the pipette because we don't make money. You don't hear people saying, "Hey, I'm catching pipettes. I'm catching pipettes." No, you say catching pips. We don't care about this, but guess what? This can stop us out. This can kill our spread. It's kind of ironic how we can't make money off of it, but it can stop us out. It can stop us from making money, right? The fourth number from the decimal is the pip. 1, 2, 3, 4. So the 7 here is the pip. We got the pipette, we got the pip, and the pip. Now you hear people say I'm catching these pips. This lets you know if you're making money or you're losing money. If you're going up, you could be losing money, you could be making money. You're going down, you could be losing money, you could be making money. Make sure you know that you are counting this as the pip and not this as the pip. All right. Here's your pip breakdown. Here's your basic math 10th place. All right. 10th place. Basic math here. But write this down. Take a snapshot of it. Know this. This is for basic Forex pairs right here. All right. This is for basic Forex pairs right here. We'll get into JPY in a minute. This is for basic forex pairs. So you have the pipette, 1 pip, 10 pips, 100 pips, 1,000 pips, 10,000 pips. Again, we have pipette, 1 pip, 10 pips, 100 pips, 1,000 pips, 10,000 pips. That's your placement on your pips. So when you see GBP, JP, or GPUSD, all right, you're going to see it, or this is Euro USD, you see Euro USD, you'll be counting 1, 2, 3, 4. You're going to be looking at this number mainly to let yourself know if you're making money or if you're losing money. This is the important number here you need to be looking at. This is also the important number you need to be calculating as well off your risk, which we'll get into soon. This is your pip breakdown. Now, go into JPY. All right, JPY. So JPY, the third number from the decimal is the pipette. So 1, 2, 3, this 8 is the pipette. This is your pipette here. Again, we don't care about this number because we don't make money off it, but it can stop us out. It can stop us from making money. This can right here either tightens the spread or it loosens that spread. Like right now, the A range, the spread is ridiculous. You place it right now, you're going to be down a couple dollars. All right. The second number from the decimal is the pip. All right. The second number is the pip. The pipette, the pip, pipette, the pip. So when we're looking for numbers to go up or go down, we're making sure we're looking at that second number from the decimal. Give me some ones in the chat if you're following me so far. Anybody lost? Let me know. All good. We looking all good. We look all good. All right, looking good. Looking good. We're looking good. All right. All right. So we're looking good here. Cool deal. Cool deal. All right. So we have somebody said not lost. All right, cool. Not lost. All right. So we have the pipette and the pip. Too easy. Now let's talk about indices. Now I am going to talk about indices very short. All right. I'm not going to go into gold and all that stuff. That's for a later date. We'll do that at a later date. I'll post that. I'll do that our next quarter. I don't want you guys like trying to figure out all the gold and trying to trade it all day. Like it's a volatile pair, but it runs the same as these indices. Now, gold is gold and silver, platinum, copper. They all are very volatile and their spreads are big. So their pip count is different because every broker is different. Every broker doesn't have a pip count or have a point or pip count the way, Nash Markets or FX Sway does. Everyone's different. But we're going to talk about the indices. All right, indices. Now, indices, every broker is different. I'm going to talk about from a broker like Nash Market, similar to FX Sway. All right. So these brokers have a pretty good payout on these indices by using lower lot size, by using micros and minis. All right. So on indices, here's your indice breakdown for US 30, SPX 500, NAS 100. I'm not going to go into German 30 or Japan 225. I'm just talking about the ones we always trade. They are measured the same. They're measured in points. They're not measured in pips. They're measured in points because of the stock market. All right. How many points it goes up, how many points it goes down. So, for example, 34474.12. Who knows what pair this is from? Let me know. Let me know in chat. Anybody knows what the pair this is from? What pair is it? If you're an avid trader, you know this pair. US 30, that's right. It's US 30. All right, so US 30 goes up 100 points. All right, 100 points. This is how it works. So 34474.12 goes up 100. Guess what, guys? There's no magic math to this. It's just add 100. So what does it go to? 574.12. All right. Give me some twos in the chat. We're going to break this down so you guys don't get lost when you're counting these points. All right. That's the basic right there. That's the basic right there. That's basic 100 points. Now, this is equivalent to 1,000 pips, equivalent to the Forex market. 100 points is equivalent to 1,000 pips. All right. So, for example, 0.01 equals 0.10 pips or equals $1 per pip. All right, equals $1 10 cents per pip. All right, which is $100 if it goes 1,000 pips. Now, this can be something like Nash Markets, FX Sway. if you have FX Choice. I'm talking about brokers like that. I'm not talking about brokers like Global Prime, Owanda. Those have different measurements because they are regulated brokers like that. All right, they're regulated brokers. These unregulated brokers, such as KLT4X, what's that trash one? Hugo's Way. All right, it's equivalent to this. So if you use a 0.01, it's looking at 10 cents per pip. Sometimes they go $1. All right, they'll go $1. They'll go $1. All right. So majority of the indices will go $1. If you put 0.01, it'll be $1 or a $1 going up. Every time it goes up, it'll be $1. That's how it is. That's how it is. All right. So this is 0.01, all right, which is 0.10 plus 1,000 pips is $100. All right, $100. So what it looks like is 0.01, which is $1 per point. So you put a 0.01, it'll be $1 per point. So every time you get a point, it's going up $1. So you get 50 points, you got $50. You got 100 points, you're getting $100. All right, that's equivalent to 1,000 pips. That 100 pips. That makes sense to you guys? Don't overthink indices. It's just points. You go 300 points, you add 300. It goes 1,000 points, you add 1,000. This number changes to 5. All right. It goes 6,000, you add 6,000. That's how you count the points on the indices. We tracking? We tracking? Let me know. This is why you don't have to use much. All right. This is why you don't have to use much. They're volatile pairs, so that's all I'm gonna put on that. So I'm gonna put on that. All right, for indices. I trade them. I do trade them, but I don't encourage you to trade them unless you have a couple $1,000, and we'll get into that in a little bit. All right, so now we have that. All right, let's talk about SPX. All right, so SPX, well, same day. It's gonna be the same deal. Same deal. Don't even worry about that. It's the same thing. US 30 and SPX, they move the exact same, and their pip count is counted the same way. Point count counted the same way. So don't overthink it. It's just points added. Simple addition. Write this stuff down. This is the most important part of this class. So risk to reward formulas, your max risk. This is how much you are willing to lose in the market. All right. It's how much you're willing to lose in the market. You say, I'm coming to the market, only wins $1,000. That's it. I don't want to lose no more than $1,000. I don't want to lose no more than 500. I don't want to lose no more than 50. I don't want to lose no more than 6,000. This is you saying, I don't want to lose this much. When the market taps me out, I'm out of there. So your account size, how do you calculate this max risk? You take your account size and you multiply it by 2% or whatever percent you're measuring. So if you got a $5,000 lot size and you only want to risk 2%, you multiply it by 2%. That will give you how much you are willing to risk. If you got a $60,000 account and you only want to risk 3%, you multiply it by 3%. It'll give you the number in dollars. All right. It'll give you the number in dollars. And you will only be risking that much. You have to be disciplined with this. This right here saves your account. All right. This right here saves your account. This step right here, max risk. Your lot size. How do you find the lot size? All right. To find the lot size, you take the max risk, how much you're willing to lose, take your max risk in dollars, and you divide it by your stop loss. So if you have $5,000 that you only want to lose, but your stop loss is 76 pips, all right, you got to take 5,000 and divide it by 76. All right, give me some threes if you're tracking. That's the second important one right here. First important one, the second important one. Cool deal. Look good. All right. The third important one. All right. Your risk to reward. How do we find that? You take your take profit and you divide it by the stop loss. Simple as that. The big number divided by the little number. So TP divided by stop loss. This will give you a ratio. All right. This is going to give you the risk to reward ratio. Now, once it gives you that ratio, you'll have your max risk in dollars, you have your lot size, and now you got your risk reward. Now you are ready to take the trade. Who cares about how much money you're about to make, right? We only care about this right here right now because we need to get into this trade properly. These first three right here, you need to make sure you have this on your MT4 or in your trading plan because this is what's going to help you be disciplined in risk management. Very important. This right here, I can guarantee you master this, you will not ever blow an account again. I haven't blown an account in 5 years. 5 years. I've been trading 6. I haven't blown an account in 5 years. All because I mastered risk to reward. All right. That's how it works. All right. So how do we make money? Take your lot size and divide it or multiply it by your TP, or simply take your max, simply take your lot size and multiply it in TP. So what happens is in your lot size, so who knows what let's say 0.03. What is that in dollars? 0.03. What's that in dollars? All right, 30 cents. All right, so what is 5.00 lots converted into dollars? $5.00 lots converted into dollars. $50 per pip. Perfect. All right, last one. What is 0.86 lot size converted into dollars? All right, perfect. Now I'm asking you this because when you take your max risk in dollars, all right, when you take your max risk in dollars and you divide it by your stop loss, right, that's going to give you a we'll do an example. I don't want to confuse you guys. Keep this here. We're going to do it live anyway. Don't worry about it. We're going to do it live. Don't worry about it. All right. We're going to go back to that. So we're going to do it live so that way you don't get, some of you guys are tripped up on that before. So we're going to get you guys rolling on that. So make sure you guys have this down. All right. Make sure you guys have this down. I'll give you guys a second. Write this down. Max risk, lot size, risk reward, and profit. And then we're going to start doing some problems. Now, when you're doing risk reward, don't worry about what other people are using. Now, also, you want to make sure you're using consistent. So you guys always hear me in chat, be consistent, be consistent. What I mean is if you're using a 50 cents per pip, all right, if you use 0.05, or if you're using let's say $5, because some of you guys don't even use that anymore. You guys are big money now. So let's talk about using bigger lot size. If you're using $8 per pip, 0.80, use that for every position that you are taking, all right, unless you are twin trading, which we'll get into that as well. But if you are taking GJ, all right, I'm taking GJ for a buy, I'm going to use $8 per pip. If I'm taking GU for a buy, I'm going to use $8 per pip. Whatever you use on that single position, you need to be using it, all right, consistently. The moment you use a 0.75 or a 0.90, all right, you are already messing up your risk to reward. You're already messing up your percentage, all right, because you're trying to win big to cover your losses. We don't want that to happen. Just continue. One, you should be already following your analysis, but your risk to reward should already be on point. You could win more trades, so you could lose more trades and win, and you could lose more trades than you win, all right, but still profit. All right, you lose more than you win and still profit just by consistently using the same lot size over and over and over. All right, so let's talk about it. All right, I'm gonna switch up for a second. Let me know you guys can see this still. 69,212. You guys see that? Still see my screen? I know I switched over, so we all good. All good, all good, all good. You said. All right, we all good. All right, cool. All right, so we have risk to reward. Now I want you guys to take your formula. All right, your formula, which is, what is it? Stop loss, or TP divided by stop loss, right? So TP divided by stop loss, we're going to do this. Let me put my calculator up. And we'll do them live. All right, here's the calculator. All right, so we have 212 with reward. That's your profit. Your risk is your stop loss. So you got TP, that's your stop loss. Rewards the TP, stop loss the risk. So $212. So sorry, $212. 212 pips, 212. All right, divided by 69. That's going to give us 3.07. So now what that happens is we only want to look at 3.0. This one right here. These numbers right here don't matter. This number right here and beyond, This is all spread right here. Give or take your spread. So you might be like, all right, I'm gonna make $100 off this 100 pip move using a dollar lot or lot size. But this right here, it might give you, $105 because it's spread, or because your fee or because your charge. That's what all these numbers mean right here. We could disregard those because only MT4 knows how much we're going to really make in the end after they give us the fee, the charges, and the swap, right? So this is what these numbers are. All we care about is this 3.0 right here. This number right here. So how do we write that? One trade to 3.0, which is your risk reward. So one trade, we're tripling our profit. Give me some twos if you're following me. One trade, tripling the profit. So we want to see everything risk reward no less than 2. All right, no less than 2. All right, good deal. All right, so we're going to do it again. We're going to do some more. So we got 236 divided by 88. That's going to give us 1.26, right? 1.26. These numbers don't matter. So 1.26. So risk to reward is 1 trade to 2.6. That's our risk to reward. All right, I'll let you guys do the other two. Just do these 3 right here. 1, 2, 3. Let me know the answers. If you already did them, let me know in the chats. If you already did them. 26, 92, 15, 62, 19, 6. 1 to 3.5. Y'all, you see, look at me. I can count. Always count on y'all. Y'all already on it. Already on it. All right, let's look at 92 divided by 26. 1 to 3.5. Look at y'all. Geniuses. 3.5. All right. What's the other one? What's the next one? 1 to 4.1. Let's check it out. 62 divided by 15. 1 to 4.1 looks good. All right, and then we get the last one. What's the last one? 1 to 0.3. That's a 0.3, right? I think that's a 0.3, I see. All right, let's check it out as well. 19 and 6. So 19 divided by, 6 divided by 19. 6 divided by 19. All right, 0.3. Good deal. All right, 1 to 0.3. That's a trash risk reward. We want all of these. We don't want this. All right, we don't want this. We don't want to risk 19 pips to try to get 6. That is trash, right? So we don't want to do that. All right, let me know. Give me some forwards in the chat. If you roll with me, you let me know you're good. Anybody lost? If you're lost, just type I'm lost, and we will go back. It's not we don't want to leave nobody behind. This is the most important class you're ever taking Forex. Or learning to invest in Forex. All good? I got 12 people on here, 13 people on here learning this. I got one answer. Come on, y'all. Let me know. This for y'all. This ain't for me. This for y'all. This for y'all. All right, we look good. All right, moving on then. Moving on. All right, so GBPJPY. Now the entry. All right, our entry. So somebody let me know what the sell formula is. Let me know in the chats what the sell formula is for this. What the sell formula is. And then we'll do this problem. Sell formula. Stop loss minus your entry. All right, good deal. So you come to the charge, you mark up sales on GBPJPY. Now, 160.660, that's your entry. Take profit, your stop loss. This is what your risk reward tool reads. This is your account size right here, right? It's your account size and how much you want to risk. You come to the market. I got $25,300 in my account. I want to go ahead and risk only 2%. Great. But you got to find your risk to reward, the max risk, how much you want to lose, the lot size, and your profit. But first, before we do all this, you need to find out how many pips you're going to earn, what your risk is for your stop loss if it gets stopped out, and your risk to reward. So let's find that out. So the first deal we have stop loss minus entry. All right. So let's take a look at it. The stop loss is 161.39. Remember, second number for a decimal is your pip. All All right, second number is your pip, 161.39, and we're gonna subtract it from your 160.66. All right, that gives us 0.73. So we got to use our placement of the pips. So we have 1 pip, 10 pips, 100 pips. Again, 1 pip, 10 pips, 100 pips, and we're going to multiply it by 100. We got to get a whole number, right? Equals 73. So 73 pips. So it's 73 pips from the take profit. Is that what it was? Sorry, from stop loss. 73 pips, stop loss. Stop loss, 73 pips. All right. All right, now your take profit. So what's the take profit one? What's your take profit? What's your take profit? $260. So entry minus take profit. All right, so entry, so which is 160.66, and you're gonna subtract it from your take profit, 158.05. Second number is your pip. So all right, so we have that 2.61. So we gotta go ahead and go to our placement. 1 pip, 10 pips, 100. Multiply by 100 gives us 261 pips. Good deal. 260, 61, give or take your spread. Good deal. So 260 pips to your TP. That's good. We like those odds. We know we have a good risk to reward so far. To find our risk to reward, we have to take the big number divided by the little number. TP divided by your stop loss. So 261, right? Sorry. 261. So 261 divided by 73. Gives us 1.35. Awesome. Risk to reward. So we know we got a good risk to reward. You like those odds. You drew your risk to reward up. Now we got to see how much you really want to risk. How much you want to come on and risk. What am I doing? Go ahead and risk. All right. So we got $25,000, $25,300. So how do we get the number? How much you want to risk? 25,300 times 2%. $506. So you come to the market, you're like, I'm only losing $506 on this trade. That's it, nothing more. You got to be disciplined on that. All right, got to be disciplined on that. So now you got your account size. All right, now you got to find your lot size. How do you find a lot size, guys? What's the formula? Find your lot size. So to find your lot size, this is what I was talking about. Convert it into dollars, or dollars into pips, or pips into dollars. Here's where we go. You take your max risk, right? $506 max risk divided by your stop loss, 73, equals, oops, did it wrong. 506 divided by 73. There we go. Equals $6.93 per pip. Again, this formula for your lot size is your max risk divided by the stop loss. Max risk divided by your stop loss gives you your lot size. It will be converted from dollars into pips. Dollars into pips, $6.93. So what is that going to be converted to in pips, guys? Let me know. Into lot size, $6.93. What's that lot size? All right, 0.69. Good deal. We're tracking. Now, how much are we going to make? How much money are we going to make? So $6.93 times $261 gives us $1808.73. That's a good. How many like that? Give me some ones you like that. I like the mods. A whole lot. 1808. All right. This is what you guys. This is a trade that you guys took. This is a trade that somebody took. All right. So I'm taking the trades. I'm doing trades that y'all already took. Somebody made this. I don't need to say names, but y'all made this. All right. All right. So that's done. Everybody good on yens on the JPY pairs? Are we good on that? Give me some yeses, some nos. Let me know. Good. All right, good deal. All right, cool. All right, now GU, everyone's favorite. Everyone loves GU. So Let's talk about GU. Now we have the entry. So what's our formulas for entry, and what's our formulas for take profit, and what's the formula for stop loss? What's that? And we'll calculate it. So give me the first one. Take profit. What's the formula? Entry minus your stop loss. That's for what? Entry minus stop loss for what? Let the people in the back know. All right, for your stop loss. All right, we're going for stop loss first. So entry minus stop loss. Let's do it. So big number minus little number. So 1.2066, because we care about the fourth number, not the fifth number. All right, and we're going to subtract it from our stop loss, which is 1.2033. We get this number. All right. So how do we get this? We gotta do 1 pip, 1 pip, 10 pips, 100 pips, 1,000 pips, 10,000 pips. So 1 pip, 10 pips, 100, 1,000, 10,000. So multiply by 10,000. Oops. And we get 33. All right, we get 33. So 33 pips for your stop loss. All right. It's pretty tight so far, it looks like it. So let's see what kind of trade this is. All right, so what about our take profit? How we find that? Take profit. TP minus your entry. Cool deal. So TP is 1.2134 minus your entry. So TP minus entry, 1.2066. Gives us this number here. So we got to convert this, all right, from our pip for our pip placement. So we got 1 pip, 10 pips, 100, 1,000, 10,000. Multiply by 10,000 gives us 68 pips, right? 68 pips or 69 pips. It's like 68.7. We'll go with 69. How about that? Give or take your spread. We'll go with 69 pips. Cool deal. So 69. Oops. 69 pips. So now let's talk about our risk to reward. So we take the TP divided by stop loss. 69 divided by 33 equals 1 to 2.0. So that's a good risk to reward. It's a good risk to reward. So 1 trade to double our risk, to double our reward. That's our risk reward. Now you have $50,000. All right. Yeah, you can round up because that's fine rounding up because that roundup is going to be your spread. I mean, like I said, you might be making $100 that you calculated, but when you close out MT4, it might give you 106, might give you 104, depending on what your swap charge or what your fees are. All right. So those numbers on the end extra are extra. That's what those numbers mean. And we don't know until we close out. That's just the way it is. We don't know until we close out. Only MT4 or MT5 knows that. The broker is going to either take your money and subtract some charges, or they're going to take your money and, add the charges, which is a plus when you get $5 extra on top of your trade. Nothing wrong with that. All right. So, but yeah, you can. Or you talking about round up if it's like, you mean if it's like 3.5, like 3.57? No, don't round up. So if it's like this, like 1.3 so if it's like this, your risk to reward is one trade, 3.57. All right. No, you don't round up. Just keep that 5 because those extra numbers are your spread, the transaction fees, the swaps, all that stuff. That's what those numbers mean. So you're just going to keep that because it's going to be based off your lot size. Because if you'll mess up your lot size if you calculate those numbers. But yeah, good question. All right. So we got $50,000. So 50,300 and we only want to risk 2%. Good deal. Some of you guys got this nice account. So here you go. This is what you're going to use. You got $50,000, $300, 50,300 multiplied by 2%. All right, so you're willing to lose $1,006. That's your max risk, $1,006. Here you go. $1,006. All right. Now we got to find our lot size. So how do we find our lot size, guys? How do we find that? What's our formula? From the last one. What's the last one from the last one? This is where you got to convert your dollars into lot size. Max risk divided by stop loss. Good deal, good deal. Max risk is going to be 1,006 divided by stop loss, which is 33. All right. So $30.48. All right. $30.48. So what is that converted into lot sizes? $30.48 per pip. Sounds like a lot, right? I know. So what's it going to be in lot sizes? $30.48. Close. That's close. 3.40. 3.48. Here you go. 48. All right, 3.48. You do 3.4. You're not wrong if you do 3.4. It's okay. You're just being a little more conservative on it. It's going to be an extra, what, $30 maybe, depending on spread. But you're not wrong. 3.4 is where you want to be at. As long as you got this number in there, you're good. You know what you're risking. All right. 3.4, you're not wrong. It's okay. All right. You're risking. All right. That's what you're risking. All right. You want to risk no more than this right here, 3.48. Anything lower, you still in your standing and your discipline. But don't go 2.48 because now you're just messing your whole risk to reward up, or messing up your whole, your max risk up. You're now making it 1.5% risk. All right. So make sure you're using close to your 2%, your max risk. All right. If that's what you're going to do, max risk. If you want to use 1.5%, go for it. Using 1%, nothing wrong with that. But the max risk should be 2%. So before I go why this should be 2%, all right, let me know if you have any questions. Give me some ones if you're good, all right? If you're lost, just type lost and we'll just go over it. That's all. We all good? Some ones, we looking good. Y'all quiet today, man. Y'all quiet today. Y'all must have got crushed today. What's up? Y'all must have got crushed. I need a hug. Some of y'all sick. All right. Good deal. Very important. This is very important. Now, why are we using 2%? Here's why. So let's talk about personal accounts first. Personal accounts. Now, personal accounts, you don't have drawdown rules like the prop firms. You know what I'm saying? You don't have drawdown rules and everything. You have just your fund, just your account, your personal account. You trade every day. You withdraw every day. Now, when you lose money, right? You have to ask yourself, am I okay with a drawdown of $5,000 on a $40,000 account? You got to ask yourself that. Because if you close out that $40,000, all right, you're only going to be back with $35,000. Now, $35,000 to get back up to $40,000, that is psychological. Because now you're revenge trading to get your five bands back. That's a lot of trading. All right, that's a lot of trading. I'm not okay with losing $5,000. I'm just not. I'm not okay losing $5,000 on a 40K account. It's just not happening. All right, not on one trade. That is just, you gotta have a good risk to reward. All right, that means you're just letting that trade just roll. It's just rolling, right? To go down 5,000, or your lot size is just crazy. So when you're looking at this 50,000 right here, this $1,000, this is easy to come back from. You lost 2%. So here's why. You take a trade on GBP/JPY, right? We're gonna do some math here. You take a trade on GBP/JPY, right? You calculate, you're gonna do 100 pips, right? And let's say you're gonna do 100 pips, and you're gonna trade you let's say two standards. Two standards, right? You're gonna trade two standards. How much is that TP right there? How much is the TP? How much is you going to make if you hit that TP? So what's the TP going to be? If you hit this TP, what's your amount going to be? What's the profit? $2,000. Cool. $2,000. So you're going to make 2K. All right, now let's talk about stop loss. Your stop loss, let's say it's 50. Let's say it's 50. Let's say it's 50. Yeah, say it's 50. All right. So tap that. So now we got a risk to reward 1 and 2, right? So your 50 is your stop loss. How much you're going to lose if you hit the stop loss? 1K. All right, you're going to lose 1K. All right, you lose 1K. So now you making 2K, you're risking 1K to make 2K. Perfect. That's what you want to see. All right. Now imagine you have 6 of those trades in. Same method. All right. Same method. So you're risking 6K to get 12K. Everyone likes those odds, right? Everyone likes those. We see it's what you use. The average trader has about 5 to 6 trades in their MT4 rolling. But if you're using the consistent lot size, all right, and you do everything like you're supposed to do, and you type in 6 trades like this, let me know in the chats. Give me a 1 in the chat if you're okay, a 2 if you're not. Let me know if you're okay on a $40,000 account, or let's say $50,000 account. Are you okay with drawing down $6,000 on your personal account? Let me know. 1 for yes, 2 for no. Everyone says no, no, no. All right, no, no, no. Okay, so you guys are agreeing. You guys are seeing it then. So to prevent this from happening, all right, to prevent this from happening, you do not need to put in 6 trades. This is where you marry your pair, not the trade. This is why you trade 2 to 3 pairs, because now, all right, you risk half of this and you make half of this. That's a lot better. That's a lot cleaner. This is a hell of a lot easier to get back than $6,000. All right. If you recover throughout the week or the month and you lost 3K, you can make this back without having to revenge trade. The higher your loss, the more psychological it becomes. All right. So this is where you dumb down your pairs. You don't have to have 6 trades running. You don't have to have 7, 8, 9, 10 trades running, trying to manage 9, 10 trades. I don't know how you do it, but that's what you're trying to do. Don't do that. Manage between 1 to 3 pairs. 1 to 3 pairs, make it consistent, and you're good to go. This will also allow you to twin trade. This is talk about personal accounts as well. I'm still on personal accounts. I don't fund it yet. I'm going to get to that. On your personal account, this will allow you to twin trade. So what I mean by twin trade is you have 2.0, all right, on GJ. So you have 2.0 on GJ. That's your total lot. Well, instead of having 2.0 on the entire trade, dumb it down to 1.0, 1.0, both positions. This will allow you to take a TP1 and a TP2. Give me some 3s in the chat if you're tracking me with that. This will give you a TP1 and a TP2. This will allow you to go for that analysis that you want to go for 100, 200 pips. So you can go 50 pips and then go 150, or you can go 100 pips and then go 250. This is what allows you to do it. This actually maximizes your gains. All right, this actually maximizes your gains. All right, so that's how you should be trading your personal accounts. Don't go crazy on them. All right, make your money, be out. 5% a day, 4% a day, 3% a day. Do you know how much 5% a day is on this? $5 grand. That means you're making $5 grand a day on your $50,000 account. $4 grand a day on 40. All right. So if you're making your 5%, all right. Your 5%. You're talking about, $2,500. All right. Some of y'all make 10%. All right. So you guys make 10%. Trying to make 10%, but 5% on that 50K, $2,500 a day. That's a lot. It's a lot of bread. It's a lot of bread. So you have to understand what you are making. You also got to be comfortable about taking your money in the market. Be comfortable. All right, I made 1,000 today. Cool. All right, I made 1,300. I'm done. I'm good. Tomorrow's another day. All right. Don't go crazy just because you made 5,000 in one day and the next day you want to come back and try to make another 5,000. That's greed, guys. That's greed. And that is why you have to be consistent. Don't be consistent Tuesday, Wednesday, Thursday. But Monday and Friday, you get in those markets and you get smacked. So everything you were making throughout the first 3 trade days, you just pretty much broke even. That's a waste of a trade week, right? Some of you guys are in that cycle and trying to get out of that cycle. So let's get out of that cycle. So let's use proper risk management. And this is where it all starts. Now, let's talk about funded accounts. Now, funded accounts have rules. Once you're funded, you still have the same rules as your challenge was. It's the same rules. So let's talk about this drawdown. All right, now in drawdown. Prop firms, they have a drawdown rule. You can only draw down 5% on some accounts, 6%, depending what your prop firm is. So let's talk about drawdown. Drawdown is if you have $50,000, how much can you draw down on that $50,000 if you're, let's say TFT, all right? What's your drawdown on TFT? On your account, what's your drawdown? Your drawdown is what? Someone let me know. What's your drawdown? 6%? So 6%? $6K? Your drawdown $6K or the $3K? What's your drawdown on your 50K account? What's your drawdown? $3K. All right, so your drawdown is $3K. $3K. All right, so $3K. You can only draw down $3K, which is what, 5%? Yeah, 5%. 5% drawdown. 10% profit, 5% drawdown, correct? Let me know if I'm wrong on that. Let's see what you at. Right? All right, so 5% drawdown. Perfect. All right. 5% drawdown, $3K. I'm gonna make sure, because I know we got a whole bunch of stuff. Make sure some of you guys got different like standard, rapid, all that good stuff. So I'll make sure we're on the same page. All right, that's your drawdown, $3K or 5%. This number is highly important. All right, that 5% is important because if you breach it, guess what? You out of there. Your account is gone. All right, you took all that time to get your funded, and then you got you a nice payout the first month or weeks, 2 weeks. You got a nice $7,000 payout, and you go back, and then you go and you lose your account because of the daily drawdown breach or the max loss. Let's talk about that daily drawdown. Let's stay out of this. So you have 5%, right? 5% drawdown. Let's talk about your analysis. Your analysis is 100 pips. All right. Analysis is 100 pips. All right. Now, we're doing 2%, right? If we're risking 2%, what is our max risk? We're doing 2%. What is our max risk? So we do not hit 5%, give or take on pairs like this because they're volatile. So 1K. All right, 1K. Max risk is 1K. We agree, 1K. I see something else too. I see some other numbers. We agree. Let's check it. 50,000. All right, and times your 2% is your 1K. All right, 1K. Too easy. All right, so 1K risk. 1K risk. All right, now let's talk about that 1K risk. So you can only lose 3K. So if you put 3 trades in with the same 100 pip moves that you do, and they all go south on you, right? You're out of there. So let's prevent that. So we have 100 pips and we're only risking 1K, right? Let's risk 50% of this. So let's reduce this to $500. So why are we reducing the $500, Coach? Because you have freaking 30 days to make it in the market. Oh my gosh, what are we in a rush for? You got 30 days. $500. $500. $500. Why do we want to get rich yesterday? We don't need to do that. So why are we risking $500? Because let's calculate how much we need to make per day. You got to make 5K, correct? 5K is what you got to make. So you got to make 5K. You got to make $5,000. And we got 30 days to make it. So let's take off about 5 of those days. Matter of fact, let's take off let's take off 6 of those days. So we got 24. So 5,000 divided by 24 days. We got 24 days to get this. All right. We got to make $208.33. Give me some ones in the chat if you follow me so far. $208.33 per day for 24 days of trading. You could lose a couple days, holidays, and weekends if you can't trade. Get it? Let's just say 24. You break it down, $208. You guys can make this, right? If you're halving this risk to 500, you're risking 500. It's going to take you a few trades to really lose. Now, you really got to lose every trade at $500 to breach the 3K. And you have a stop loss. All right, this isn't counting your exits, getting out early at $160. This ain't counting, you got not 8 exits. You got, if you're using LC, you ain't losing 500. You use the ESC, you ain't losing 500. You use the KC, you damn sure ain't losing 500. So why are we going to care about losing 500 if we got exits? If you set it and forgetting it, yeah, you will. But if you're not, you have your exits, you won't even lose close to 500. So why are we breaching accounts, guys? Why would we breach the account? What would make us breach the account? Psychology. Psychology makes us breach the account because we want to hold on because we see that we can get $1,000. We can make $2,000. All right. We don't need to do that. We don't need to do that. That's on any account. So if you see this per day, $208 per day, and you're risking at 500, you're not going to breach the 3K. Now, if you go on 100 pips, and you have you're in profit, and you have your exits, and you're making $2,000. By the time you get to your exit, you're already $600, $700, $800 in profit, depending on how you're taking your exits and your trades. Taking your take profits. All right, you're $600, $700, you're $1,000. You might be $1,500 already in profit just off those positions. Take your money when you see it. As soon as you see your money, all right, and you hit your goal, be done. Now, this is where this comes discipline. You make $400 that day. You make $400 that day. You only need 208. Keep it. All right. $400, be done. Your day one, you're good, man. You're already ahead of your game. You're 2 days ahead of your game. Guess what? Day two, you come in, you make 500. You're done, bro. You're done for the week, really. But guess what? You want to trade a little bit. This is where it all comes. You got 900. You only need 5K. You're almost $1,000 there. You're $4,000 away, and you're only 2 days into it. And your mind starts thinking like, man, I'm about to really get it. I can make $1,000 each day almost. Give me some twos in the chat if I'm wrong. Let me know. If y'all twos in the chat, if y'all been doing this. People been doing this. All right, you're like, dang, 2 days in, I'm about to pass this challenge on Friday. I just started on Monday or Sunday night. All right. So therefore, all right, sit back, relax. All right, take half that lot size you were going to use. If you want to use that point, the $8 per pip, make it $4 per pip. You already ahead of your week. $4 per pip at 100 pips, you got another $400. $4 at 200 pips, or $4 at 100 pip on 2 or 3 moves. One, you're not going to breach that 3K for one, and you're barely going to lose any of this right here because you're going to have exit to get out. So you guys don't have to worry about trying to breach this account. The only reason you're breaching is because you're up in the lot size, and this is what happens. Traders do this. I see this every day, all day. All right. When I'm evaluating accounts, I see this 0.75, 0.35, 0.85, 0.16. What the heck is this? What is this? What are we just guessing? Oh, I'm gonna do 1.6. I think I'm okay on this trade. It looks okay. I don't know. I mean, it might go up. Let me go put something on it, and it loses. And then guess what? You're 200 pips down. Now you lost 200. Oh, this first trade I killed it. Second trade, you know what? I'm not too sure. Let me put a 3 point. That is inconsistency. You do not want to do this. Only reason you should see this in your MT4 is if you're taking partials. That's the only way you should see something like this is if you're taking partials. That's it. If you're taking partials, cool. If you're not, and this is your solid position, this is what you're putting in, stop doing that. Only time we should do that is if you have an indice, and you should not be playing indice and Forex on the same day. If you're going to trade indices, trade the indice. If you're going to trade Forex, trade the Forex. Because why? If you trade the indice, it's more volatile. So if you lose, guess what? You're going to lose everything that you made on GU. You trade US30, you go ahead and back and trade GU. You lost everything you made on GU. You go and trade AJ, and you go trade gold or trade SPX 500, and you lose. You lost everything you made on AJ. That is the cycle that continues to happen. So if you're going to trade indices, trade it that day, or just don't trade at all. Get another account and trade indices. Have your indices account. But I encourage you, don't trade indices on the same time as Forex. That's just my recommendation. I've only met one person that didn't get that got rich on indices. All right, that's it. I only met one person that really trade them, and they really profit. Only met one person. Other than that, they make the money, but they can't keep it. We're about keeping the money. So that's how you avoid your drawdowns. That's how you avoid them. Be smart. Don't be afraid to put the lot size on it, but make sure you are okay to close with losses. Risk management. All right, you got to know your pip count. You got to know your max risk. You got to know your lot size count. Conversions from dollars to lots and lots to dollars. You have to know that. If you don't know that, let me know. Somebody in the chats in the group will go ahead and send you a form, and you can go ahead and have that sheet, and you just memorize it and understand it. Now, someone memorize it, know it. You should be able to explain this to a newbie with $30.48. All right. But to reduce your drawdown, both your personal and your funded accounts, that's how you want to trade them, guys. Don't have to go crazy. You don't need much. All right. Any questions? You guys like this? Let me know. Let me know if you guys like this. You guys like this? Is it helpful? Is it helpful for you guys? Just want you guys to be good on this. That's all. It's the biggest class in Forex, right? This is why traders fail. This is right here. This is why it failed. This is why they fail, because they don't know how to count pips. They don't know the risk reward. They don't know how much to risk. That's the biggest deal. They don't know how much to risk. If you're a new trader and you come in and you have $500, 10 cents per pip should be your lot size until you are comfortable going up. Because if you are in a panic to lose $50, you do not need to be trading 0.35s or 0.03 or 0.04 or your max at 0.05. I know you guys seen those lots. I know you guys seen those. There you go. I know you guys seen those sheets. Risk 0.01 for every $100 that you have in your account. That is complete BS. Do not do that. If you want to follow that sheet, I'll give you my my Cash App, and you can send me the money. All right. If you're gonna do that, I'll send you my Cash App. You can give me the money, and yeah, you know what I'm saying. You ain't even gotta donate to the broker. You could donate to me, because that's just asking to blow your account. Don't do that. Follow your risk to reward. Follow your max risk. That's all you gotta do. 9 times out of 10 on a $500 account, that's personal. You're only gonna trade 0.01 until you got some more capital, really. Until unless you're able, some people like to flip it. But if you're new, 10 cents per pip. There's no rush. At $50, you got 10%, man. You be good. So, any questions, guys? Any questions? Since it was helpful, cool deal. Yeah, I gotta get y'all to put y'all names on here. I got some weird names. I don't know who's. I see Sherelle, Terrence, Carlene. I got Hey Family, Denise. I don't know who the rest of this is. That's all I see. Y'all all good though? Everybody's good? No questions on this, on risk management? All right, I appreciate you guys being on. If you have any questions, drop them in the chat. Let me know. Hit me up, DM me. If you're having trouble on your risk management, let me know so we can get you there. If you're having trouble, you're just not getting it, stop trading. Do not trade. Just stop trading. Be okay. Pause it for a minute. Get in contact with somebody. Let them know you are really struggling with risk management, and so we got to fix it. Once we fix it, your trading confidence will go up the roof. All right. So definitely, we care about that. I care about that. I care about your risk management. I really do. I don't want to see nobody blow their accounts, because you guys know from my experiences, I've wasted a lot. I did trying to learn this skill, but nobody taught me risk management until one day someone did, and this is how I was taught it. And from this day, I never blew an account. All right, never blew an account. Never blew an account since I learned this. Once I learned it, I can care less how much I lose. I'm gonna get it back. I got too many weapons, too much of an arsenal, entries and exits. But I appreciate you guys being on. All right. If you want to see this call, check it out on YouTube or check it out on the Academy. You guys will be good to go. Enjoy your night. I appreciate y'all. Much love.